webinar this month. We got really our top mutual fund sponsor on the phone today. We got the Capital Group American Funds. Colin Jefferson, I'm going to introduce him here in a few minutes, has got David Ford and Vahid Frederick as well with him to talk about year-end planning, so capital gains and other type of year-end tax consequences. They're going to talk in particular about some of the funds, many of which we have lots and lots of assets. A little bit about year-end volatility. We've got volatility back in the game to talk about again for the last few months, and then also a 2019 outlook. So we're really excited to have them on board. They are by far our biggest mutual fund sponsor. We have hundreds of millions of dollars of assets invested through their various funds, and so it's really nice to have them commit to this time with us today. As usual, prior to that, I've got a few announcements. I'm going to, first of all, just remind everybody, please mute your phones unless you've got a question to ask, and then unmute and pipe up. We try to make these calls as open for you as humanly possible. So if you do have a question or a comment or something, don't hold back. But in the meantime, if you could mute your phones, that kind of helps everybody be able to hear a little better. There are some, every year, this time of year, we have some year-end things that hit that have some deadlines that are important. So I want to bring to your attention a couple of them. One is continuing education, the firm element CE, and social engineering red flags. That's this year's kind of annual firm element CE requirement. If you attended the kickoff meeting in January or the compliance meeting at Lincoln's Wealth Management Forum, you should see, when you get on the website, you should see this CE requirement marked as completed. If you go on and you find that that's not the case, please let us know and we'll check records and make sure that you get credit. Again, you go to the AdvisorLink website, you go to the compliance widget, and then you select continuing education is how you get in there. Every year, Lincoln has 2 additional courses in addition to the usual AML. This year, those courses are copyright matters and share class selection in the brokerage and advisory world. Both are due by December 7th. I want to say a couple of things about that. One is both of those things have kind of come up quite a bit this year. Share class selection obviously is a big issue in the industry, and we've had some new rules around that. We've had some new enforcement around that, so it's important to pay close attention to that subject. Also, copyright matters. Probably I've seen more, as I review our annual audits right now, I'm seeing more and more reference to people sending articles without copyright permission. And every time we see these things come up in the internal audits, it's usually a reflection of what FINRA or the SEC is asking in the audits back at Lincoln. And so anyway, I'd pay close attention to that one as well, because that has probably been the most common thing I've seen in the audits, that someone sent an article in a kind of an inappropriate manner. So there are right and wrong ways to do that, and certainly if you have questions about it, check with Judy or our staff here or Lincoln, and we'll be glad to help you. But that's an important thing to pay attention to this year. Second thing are, when we think about year-end requirements, is 2019 license renewals. That process starts tomorrow, November 16th, and it runs through December 11th. So you'll receive an email. In the subject line, it'll say Lincoln 2019 Renewal Invoice. It'll provide you with a link to access your election and the invoice. As of tomorrow, you'll be able to access the renewals through AdvisorLink. via, again, the compliance widget and the licensing widget on that part of the website. So you want to review all the states you currently hold licenses in. You can elect to either continue or to withdraw. You know, it's just an annual thing I know everyone goes through is, do I still have clients in these states? Is the cost benefit still make sense? So anyway, also there might be some opportunities you have in some other states that you aren't currently licensed in. So it's just a good time to think about where you're licensed, where you're appointed, and what your needs are for next year. And then, okay, on top of that, then I wanted to mention again the kickoff meeting that is, again, going to be January 17th. We're still working out details with Lincoln on things like location, et cetera, but I feel confident it's going to be, if not in the same hotel, in the same general area as last year, so kind of that Newport area. It looks like what we're going to have is an agenda that goes from about 10 to 2:30. That will be, or 3 o'clock, 10 to 3, something of that nature. That will be the Lincoln Roadshow. It's the regional meetings that Ed and Dennis and others have been doing for several years now. So it'll be good to have that part of the meeting, but then we're going to have a WMP section that will be just us after that for a couple of hours, and then we will also have our normal, you know, dinner and awards afterwards. So please mark out that date, and we hope everyone can attend. We usually have really good attendance at that meeting. This year, we're going to have a bigger group at the first part. There's a group in San Dimas that is part of the Legend Group that was, you know, recently acquired by Lincoln, and there will be some other people from around the region that are connected to Lincoln in other ways besides WMP. So it should be a pretty large group that morning, a little bit more activity than normal. So we're excited about that, and want to be sure everybody can attend. I wanted to mention also, we have talked in the past about, you know, our work with trying to expand some of the services at Pershing, and also exploring some services and support that we might get access to Schwab. I want you to know that that is still going on. The Schwab discussions are still moving. We've had more prime movement on Pershing recently. In fact, I got an email from Joanne McKelvey. She's meeting with representatives from Pershing today to talk about how to configure a proposal tool that Lincoln or that Pershing has that we would be able to access and use to make proposals for primarily CAM's business. So it's something we've been without for quite a while. We used to have a CAM's proposal tool, and we've been without it for a couple of years. We've had several advisors look at this tool. They like it. They think there'd be a lot of advantages to everyone for us to have access. So they are working on that. We are also looking into some other access to some other services, perhaps some better trading tools, especially for those that are building their own models. Also working on perhaps expanding some of the money management access that is available on Pershing as well, so some other money managers. So anyway, a lot of work going on there. Also with Schwab, but the Schwab move is going to be a little slower because there's just a lot of workflow that has to be built out, as well as just an agreement to do business with them. So a lot of the work that Lincoln's already done with Pershing to provide process and workflow for the business that we do through that custodian. We have to do the same thing with Schwab. They're in the process of doing that. So it's, you know, I feel confident we'll have some access to Schwab next year, but it will take more time. So anyway, it's coming along. last but not least, before we get on to the meat of the program here, I'm doing some planning for next year. And so one of the things I would like everyone to think about are three things. And if you could just, send me your comments or on this and anything else that you'd like to discuss with regard to your business in 2019. First, do you see any significant changes in your business? Is there a particular market, or is there something about your business that you see is going to change dramatically next year? Something that you would like to do next year in terms of a change of strategy that we might be able to help you with? Anything you'd like to share about your goals for next year? Whether it be, a new license, a new market, a new strategy, anything. And then, of course, what kind of growth do you think you might expect next year? Anything else you'd like to share? And then what can we do for you? What would be the things that WMP in particular could do that would have the biggest impact on your business next year? So if you could just put some thought to that and shoot me an email, I'd appreciate it. We have a lot of people, and it's kind of a far-flung operation with 45 advisors in 8 states and, three different time zones, maybe 4 now, if I think about it. But in any event, please send me anything you got on those questions, and I'll really look forward to working with you and making those things come true next year. So, okay, unless anybody's got any questions or comments or something to share. All right, I tell you what we're going to do. We're going to move on. Again, it's funny. I got a call from Colin not too long ago. I think it was primarily because he was interested in helping me with my clients, and I did explain to him that that wouldn't take all that long, but that I did have access to a lot of people that he really should talk to, and that's all of you. So Colin was really nice to help work with us. They were very interested in being on our list of presenters, and so without further ado, I'm going to introduce Colin Jefferson. He's our area sales representative for the Capital Group, and let him introduce our other speakers and move on with our presentation.
Perfect. Thank you for that, John. And first and foremost, just want to start with, and I speak for all of us on the call here from the Capital Group, that we hope you and your families are safe during this difficult time in California, and that you all are in our thoughts currently. My name is Colin Jefferson, and I'm your area sales representative here at the Capital Group. I'm joined by David Ford, who's the Vice President of the Capital Group and working in the territory. And David and I are joined by Vahid Friedrich. Vahid works at the Capital Group as an advisory specialist. Vahid's team of advisory specialists work as a liaison between the portfolio managers and the sales representatives, such as David and myself. And as John has already mentioned, today we're going to be discussing capital gains, year-end volatility, and also capital thoughts on 2019. We also hope to answer any questions that you may have for us at this time. So without further ado, Vahid, I'll let you go ahead and start us off.
Thank you, Colin, and good morning, everybody. Hopefully everything is starting to settle down a little bit. I know it's going to take a little while, but let's talk a little bit about what's going on at the end of this year, and then we'll move on to our outlook for next year. And the first big topic that's going to come up this year is capital gains. This is going to be a very significant year for capital gains, not just at American funds, but I suspect at a lot of different fund companies. For those of us who've been in the business for a few decades, we kind of are familiar with this pattern of capital gains increasing and going up and up as the bull market gets older and older. So now that we're approximately 9 years into this bull market, we're definitely in the heart of this season of high capital gains. And this year, we're going to have a situation where funds are realizing long-term capital gains and paying those capital gains to your clients at the same time that the market in general is suffering a little bit. Definitely the market's flat and mostly down for this year in the U.S. And down in non-U.S. And so it's helpful, I think, to do a couple of things. One, For those clients who have investments in taxable accounts, make sure that you do warn them that capital gains are coming out this year and that those capital gains are realization of long-term gains by the managers. These are all things that the managers have been making money off of for many years, that they have decided now is the time to sell. And whenever you sell in a mutual fund, you do have to pass those gains along to the investor. And so that's where the capital gains distribution comes out. It doesn't have very much to do with what's going on in the market this week or this month. The other thing to do, I think, that is a very nice value add for your practice, for your clients who have put money into any investment, not just an American fund investment recently. So many clients who have put money into the market this year may be down and actually have a taxable loss on the books. And so a nice value add you can do for those clients is tax loss harvesting. When I look through the funds that are the biggest holders in your branch in your area, it's AMCAP, Capital Income Builder, Fundamental Investors, and New Perspectives. If your clients are holding losses in any of those funds, we would suggest selling out of that fund, moving that money into an ETF for about 30 days to make sure you don't trigger the wash rule, and then moving back into the fund. I think that's a great value add for those clients to offset capital gains they're getting somewhere else. For ANCAP and Fundamental Investors, I would suggest the ETF SPY, and for Capital Income Builder New Perspectives, I would suggest the ETF ACWI, the All Cap Global ETF, and the S&P 500 ETF. If you do have any questions on another strategy or another particular fund of what you would do a tax loss harvest exchange with, just let me know. We do have suggestions for all of our strategies. And of course, if you've got losses to harvest from other firms, probably their representatives can answer that question. But if you just want to do it in one-stop shopping, I can answer that question too pretty easily most of the time. In terms of how much of capital gains are coming out there, like I said, it is going to be fairly large. For AMCAP, for fundamental investors, and for New Perspectives, we're talking about somewhere in the 5 to 9% of the market value will come back as a capital gain at the end of the year. And for Capital Income Builder, it's going to be a little bit shy of under 2%. One thing that can help with that discussion with clients is when they say, why is this coming, is to tell the clients what is happening in the fund. So with AMCAP, that's mostly sales of Broadcom, Netflix, and Oracle. For fundamental investors, it's mostly sales of Amazon, Apple, Boeing, and Microsoft. And for New Perspectives, it's mostly sales of Amazon, Bayer, and Royal Caribbean. These are companies that those funds have held for many years, if not in a lot of cases over a decade, where the managers holding those positions have decided to trim or sell out completely and realize those long-term gains. For Capital Income Builder, it's a much smaller capital gain this year, and the main selling activity that's triggering that capital gain is selling some large positions in Philip Morris, which has been, as you guys know, struggling a little bit with new regulations coming in with vaping and other kind of alternative nicotine delivery systems is kind of the way the business is talking about it. So it's always a difficult discussion. People hate paying taxes. It's important to remind clients you really only pay taxes when the mutual fund has been successful and profitable. All of the fund companies that I mentioned, other than Capital Income Builder, so AMCAP, Fundamental Investors, and New Perspectives, if you compare their after-tax returns to their ETF equivalent over the last 10 years, you still have more money, even though you probably would have paid more in taxes over the years. So tax efficiency isn't always the primary thing you should be worried about as much as it's tax effectiveness. How much money do you have to after you pay taxes? And again, if you have any questions or you need some more details on that conversation with a particular client, feel free to reach out to our team. I'm going to pause there and see if there's any questions on capital gains. If not, then I'll move on to our outlook on volatility and what we think will happen to next year. All right. So with that takeaway, let's talk about the year-end volatility. So yes, volatility is back in the market. The markets are down pretty significantly for the month of October. I don't think this is an unusual amount of volatility as much as it's a bit of a amount of the volatility that I think a lot of clients maybe have forgotten or not used to. When we look at markets in general since the end of World War II, 10% or more drop in the general stock market on average has happened about once a year. When we look since the end of the Great Recession in 2009, a 10% or more drop in the general markets has only happened 5 times. So that is, this type of market correction is now happening about half as often as it used to. And I think that means that clients are just less accustomed to this type of volatility and more likely to ask questions and more likely to want to make changes in the face of volatility. I always like to share a couple of things. Now, of course, when you predict the future, it's always a dangerous thing, so take this with a grain of salt. But we can look to some historical patterns for kind of a little bit of guidance of what's happening. And the difference between a market correction and a bear market is typically whether a recession is coming or not. So a market correction, markets are down, usually down in the -10 to maybe -15 or so % range. Market corrections tend to happen very quickly. So again, since the 1950s, on average, your client is back to break even in the markets in 3 to 5 months. And market corrections almost always happen during a growth cycle, during the growth part of a business cycle. Bear markets, on the other hand, are a lot more painful. And I can't believe it's already been almost 10 years since the last bear market. But in a bear market, markets are down usually at least 20%, usually a lot more than 20%. Bear markets take a lot longer to recover from. So the average bear market, you're talking about on average about 2.5 years till your clients are back to break even from the beginning of the bear market. And then I looked personally when I was doing some research last year, I looked at every single bear market going back to the Civil War. Every single bear market except for one, that was the one that happened in 1987, occurred within 6 months of a recession. That is to say that with a big question your clients should be asking and you should be asking yourself in the face of volatility and whether you should be making any kind of dramatic changes to your asset allocation or your investments when things are rough like they have been the last month, that question should be, do I think there's going to be a recession in the next 6 months? Probability says that if you don't think there's going to be a recession, stay the course, maybe buy the dip. If you do think there's going to be a recession, then that may mean, yes, it's time to take action and maybe get out of the way of what might turn into a bear market. But again, that's probability, not an absolute prediction of the future. Those talking points, again, volatility is normal. It's good for long-term buyers. It's not happening as often as it used to. This idea that you need to really be more concerned about what's going on in the economy to affect your determination about whether or not to change that strategy. All of those things I think are very useful talking points if you need help talking to clients about volatility. And of course, like all wholesaling teams, we have a ton of written and printed materials to share with you guys that you guys can ask Colin or Dave for when you see them for help with discussions on volatility. My next topic was going to be a little bit about our outlook for 2019 and kind of what we see changing in the face of the election results. But let me pause there in terms of what's going on with volatility and see if there's any questions on that topic.
I've got one. Are you seeing, in the last few months as things have become more volatile, are you all seeing more activity? Are you getting more calls? And are you seeing more trading activity as a result of that?
We are. Now, clients, of course, are notorious for doing the wrong thing. And so I usually take a look at 2 different types of activity. The activity comes through an advisor and the activity that comes through our 401ks where there's not necessarily an advisor in between that transaction with the participant and their funds. And so we definitely saw a large uptick in activity on the 401k side and a lot more trading. Mostly, though, moving into cash, not into bonds, as bonds have been weak in the face of rising interest rates. On the advisor side, I was very pleased to see that most of the activity there went up. Total activity from the advisor side went up a little bit, and most of that was buying the dip. Now, internally, when I look at what our managers are doing on the funds that they run, very consistently, what I've seen over the past let's call it 6 to 12 weeks, is a decrease in cash levels. That is, most of the professional managers are reducing cash positions and buying stocks in a dip. Most of the advisors are doing something similar. Most of the independent individual investors who aren't necessarily talking to an advisor seem to be doing the usual and selling, of course, when things are down instead of before they're down.
Great, thank you.
All right, so feel free to interrupt me at any time. Otherwise, it sounds like a radio show. But I'm happy to answer questions as they come up. And let's talk a little bit about what we think about 2019. I think the big question that we've been having for most people is what's going to happen after the election. We do have on our website, it's called thecapitalideas.com. This is where we publish most of our thoughts. A nice article on the takeaways from the U.S. election by Matt Miller, who's our chief political economist. And Matt has 3 points to think about. One, gridlock is coming. There's no doubt about that. Gridlock tends to be good for markets. Government acting quickly, the government making major changes, instability or uncertainty about future rules around taxation and regulation tends to be bad for markets. Gridlock means stability of the rules, and that tends to be good for markets. Specifically, when we look at when the House has turned. So we've got three most recent elections in 2010, 2006, and 1994, where the control of the House of Representatives switched from one party to the other. And in two of those three post-elections, we had a short-term dip in markets, followed by a continuation of the long-term rally. And then the third one in 2006, we just simply had a continuation of the long-term rally, and not much of it, or at least not as dramatic of a dip. So when we see the House change, what we're seeing right now in terms of a dip, hopefully short-term, is not inconsistent with past results. When we look at all of the midterm elections going back to 1950, we haven't seen a single post-midterm election year that was negative for the S&P 500. So history's got a little bit on our side for next year being a good year. That also coincides with our outlook that we are not predicting a recession coming in the next 6 to 12 months. We do see some cracks, and I think the way one of our advisors, economists said is we can kind of see a recession peeking its head across the horizon, but it's not super close yet. This is one of the longest bull markets in U.S. history, but it's not one of the longest bull markets in global history. That record is currently held by Australia, which is now in year 28 of economic expansion with no recession. The other thing to focus on is that gridlock is going to be pretty nasty. There are limited areas of cooperation between the two parties. There does need to be kind of something that does need to be done in terms of promises around drug spending, limits on drug pricing, but it does seem to be that people are really setting up more about 2020 than they are necessarily about governing over the next 2 years. We'll have to wait and see just how cooperative the Republican-controlled Senate and the Democratic-controlled House can be. That is something that we'll need to be patient on, especially I think that depends a little bit on how aggressive the Democrats will be in terms of investigations and oversight. But it does seem like a lot of things are going to just be set up for the next election. And so because of that, we continue to believe, as I had said earlier, that gridlock will continue. Our long, slow economic expansion will continue. We expect inflation to continue to be in what we call the Goldilocks range of inflation. That is somewhere between 2% and 4%, probably closer to 2% than 4%. That's our feeling. But that range of inflation tends to be very good for economies and tends to be very good for equity prices. And that's, for what it's worth, our rough outlook for next year in the U.S. In terms of relative returns, we are, however, much more bullish on non-U.S. equities, and we see non-U.S. equities as much more reasonably priced than U.S. equities, especially emerging markets. To give you some numbers here, if we look at the CAPE at the average PE over the last 10 years, we're going to see the U.S. somewhere in the 26 range, Europe somewhere in the 19 and a half range, and emerging markets around 15. So that's not to say that emerging markets are cheap or that Europe at a PE of 19 is cheap, but it's a lot more reasonably priced than the U.S. at 26, especially as the U.S. continued to raise interest rates this year. The U.S. currency had a rebound after some weakness in 2017. We think that currency strength is not going to continue forever. And when I hear from the managers about where they are the most excited, it is where your clients are probably the least excited and the most unhappy. And that is buying low in those places that have struggled the most over the past 5 years, specifically international stocks and dividend payers. And so as investment advisors, I think it's always important to guide clients a little against their instincts, which is as much as everybody says they're going to buy low, sell high, what they try to do in real life is buy high, sell higher, rarely successfully. And so if you are looking for ideas of where to buy low, emerging markets and international remain very attractive. On the municipal side, we do continue to think municipals are very attractive compared to taxable bonds. Municipal revenues have grown dramatically. Municipal defaults are way down. We are not predicting a wave of huge amounts of defaults over the next year. Munis do come with a little bit more headline risk than taxable bonds, and so we think that will continue. So there might be some more what I would call headline-driven buying opportunities in the muni space. But when I look at the difference in after-tax yield that you can get from an investment-grade bond versus a muni bond, that difference is only about 14%. That is to say, if your client has a marginal tax rate of more than 14% with their investment, they should be buying munis. And that's, I mean, considering the lowest tax rate is 10%, like almost everybody should be in munis. So that is one place where we do think there's some attractiveness in fixed income. In taxable fixed income, and I'm sorry, was there a question?
Well, you pay me and I won't tell him I saw you leave.
So on the taxable side, we do think short-term interest rates will continue to go up a little bit next year. We actually think the holders of short-term bonds might be hurt and have actually a little bit less return than the holders of intermediate-term bonds as we continue to expect the bond market, the overall bond yield curve to flatten. That is the short end going up faster than the middle or the long end is going up. And so because of that, we're suggesting that people not necessarily overweight in short-term bonds, especially when you look at the purpose of fixed income in a portfolio. And for a lot of clients who are not taking distributions from their portfolio, the real purpose of that fixed income is to offset the volatility of their equity position. And that means that you want bonds that are going to zig when stocks sag. You want bonds that have some duration in them. And so we are suggesting intermediate-term high-quality bonds as the best place to kind of hedge if we're wrong about equity markets being a decent place to be next year. So that kind of rounds up our outlook of the world. I know, fairly brief and to the point is kind of my style, but I'm happy to jump in with a lot more details on any one of those topics. And so we'll open it up from there for comments or any questions.
Hey, John, it's Dave Ford. How are we doing on time? We don't want to overstay our welcome here.
No, we're doing fine. Absolutely fine. We're in good shape on time. One of the issues that I've been talking to everybody about all year pretty much is rebalancing, because we've been living in a hot market for a while, or have been, and so what we're seeing is a pretty big shift where a lot of our clients are now more weighted on equities than they originally intended. And it's kind of a trap because, of course, because of that, and as the market goes up, it certainly looks better, continues to look better, it continues to feel good in that respect, but probably shouldn't. And so I thought what I'd do is ask you, as that is kind of as a reality that we have to deal with, and we've got to get our clients back rebalanced. Because of some of these shifts that you've just talked about for 2019, is there any advice you would give when you're looking at a client's portfolio and you are actively talking about them about rebalancing? Should you also be talking about them on kind of a strategic shift in their investment philosophy, perhaps more towards non-U.S. versus U.S., et cetera?
Yes, I think that's a great example. So when we talk about rebalancing, I always like to say that rebalancing for a client means selling what you're happy with and buying more of what you're unhappy with. And in my client conversations, I always actually use that specific language to set up the rebalancing conversation, because that's what you're doing. You're selling some of the winners and you're buying more of some of the losers. And so when we talk about a strategic outlook about where's the best kind of balance right now, Capital Group, based on our portfolio series and what our portfolio managers are doing in our multi-asset funds, we're suggesting that about a third of the total equity portfolio should be in non-U.S. stocks. That's very rare to see an individual client anywhere even close to a third of their portfolio in non-U.S. stocks. So rebalancing is that opportunity not only to get that mix of stocks versus bonds back to the correct target for the risk tolerance of your client, it's also an excellent opportunity to get that client thinking about where inside the equity portfolio is going to be a good opportunity for me to buy more of. And phrasing it as that, where's the opportunity to buy more of? It's a little cheesy, but one of my favorite metaphors from the 7 years or so that I was an advisor that I used all the time was the hamburger or the chicken metaphor. This idea that I'm a bit of a country boy. I do live way outside of San Antonio. I go to Costco about once a month, and in my freezer at any given time, I have about the same amounts of chicken and hamburger. But what if I go to Costco and the chicken's on sale? My reaction is not to go home and get rid of all my chicken before it's worthless. No, I'm going to buy more chicken this month and less hamburger, and buy a little differently when the hamburger's on sale. And phrasing it as buying things on sale and rebalancing in order to take advantage of opportunities, I think works very effectively in those client conversations.
That's great. And one other question I had, I hate talking about politics in regards to investing. I don't like talking about it in general, frankly, but I think, it can become a trap and a mistake to get too focused on politics when we're talking to clients about their money, primarily because, the data tells us that these are, transient moments, and they typically don't mean that much when it gets down to it. But are you feeling that it's different this time, that there is more angst about the political kind of position that we're in, and what kind of advice are you giving to advisors or clients when it comes to those conversations when they come up?
Yes, I'm definitely saying that the media is acting as if the world has ended, and it hasn't. My personal politics aside, when we look at the way media covers every single little statement by any member of the administration as a front headline news world-shaking thing, it just seems very dramatic. And unfortunately, it's because the reason the media is doing that is because it drives readership, it drives viewers, it drives ratings, and we've seen this trend happening now for about 25 years, but really dramatically accelerating over the past, say, 2.5, 3 years. where it does seem like headlines are driven by, to put a not so nice term on it, clickbait, right? They're just trying to get readers or viewers as opposed to providing substantially useful news. I saw that a lot about coverage to Trump's trip to China. I saw that a lot on the coverage about the Treasury Department's reaction to what was going on in Russia, where the headlines just did not seem to really coincide with what was actually happening in the administration or in the legislature. Whether I agree with what was actually happening or not, definitely the headlines weren't matching. And that's true. I think that's true on both sides, whether you're talking about a liberally oriented media or a conservatively oriented media. So telling clients to remember that headlines are not there to inform them. They're there to catch their attention, and to really try and ignore the headlines as much as possible and pay attention to the fundamentals is, I think, a great strategy for kind of talking clients off the edge of a cliff, so to speak, sometimes.
Thanks. And we just got a typed in question from Rich Merrick. Rich, welcome. Rich is one of our newer advisors, and glad to have him on the call. His question is, what sectors in the equity markets do you like in 2019, both U.S. and global, and international? And you mentioned you like emerging markets in 2019. Which ones? India, China, who and where?
Absolutely. So for the first question, in terms in the U.S., which sectors do we like the most? The sectors that we like the most continue to be what we would call innovation. So we really don't look at that sector lineup and say, as opposed to saying, well, I like banking or I like technology, the way a lot of other firms do. As much as what I'm hearing from the investment managers is they're really focused. They're very picky about which U.S. companies they're willing to buy at these high costs, and two, they really want to focus on companies that are dramatically transforming or having a dramatic impact on the general business that they're in. So we're famously very overweight in Amazon and Microsoft and other cloud computing providers that are really transforming the way large data processing and kind of big data as a market is happening. And that's just been a huge and surprisingly quick generator of cash and profits for the companies that are doing a good job with cloud computing. But there's no cloud computing, so to speak, sector, right? And definitely, is Amazon a consumer retail company or a technology company? It's kind of a little bit of both. Same thing with biotechnology. We're very excited by a lot of stuff that we see in biotechnology. So most of our U.S.-based funds are overweight healthcare, but when you dig down into which healthcare companies they're overweight in, it is those biotech companies that are coming out with new and very exciting products based on the new CRISPR technology for editing DNA, especially in the cancer area. One of our main analysts in biotech is a former cancer researcher himself, and he almost feels like he's jumping up and down on the phone about some of these opportunities long term if they pan out. Internationally, the theme is more focused, not necessarily on emerging markets as much as I would say emerging markets consumers. So what we've seen over the past 10 years is really a split of emerging markets into two separate types of emerging market economies. We have the traditional emerging market economies that I grew up learning about, which are basically natural resource extraction, right? They're mining, they're farming, they're drilling, they're putting together cheap factories, they're putting something to export and sell it to the developed markets. And that emerging market, we think, will continue to struggle. High U.S. dollars is good for them, but trade barriers are bad for them. And so in general, we think that manufacturers and exporters, exporting companies who are on the emerging market side trying to export to developed markets would not do as well as the other way around, which is companies that are focused on the growing middle and consumer classes in emerging markets. So this is something you've probably heard from a lot of asset managers over the past 10 years, but it is a trend that has not slowed down at all. and that is the growing number of middle-class consumers around the world. We are looking at just enormous numbers of people finally getting enough income where they can start thinking about the future, they can start saving, and they can start buying things that you and I take for granted. In a lot of cases, those we would call them a consumer staple. Things like basic over-the-counter medicines or hygiene products, or a car that works, right? So when we're looking at emerging markets, we're not focused in a particular sector, except maybe finance. We do like banks, especially Indian banks. But I would say we are skeptical about Turkey and Argentina. Every other emerging market we tend to like, other than the ones that are currently involved in a war. So we don't really have a lot of exposure to those, of course, anyways. But companies like not Golden Corral, I think it's Coral, I can't remember the name of it specifically, but it's a Hong Kong-based franchise restaurant that's essentially very similar to the McDonald's, but it's Chinese food in China. So that's an emerging market company that's doing all its growth by opening up branches in mainland China. And we think that's the type of business that we really want to see. On the developed world side, we like companies like Unilever, which is selling just kind of consumer basic staples like shampoo and feminine hygiene products and soap and detergent, and doing an extremely good job of penetrating and getting those products into emerging market, where the brand and specifically the quality signal of having come from a Western company is very attractive to emerging market consumers who are used to very poor quality from local goods. So that's what we're excited about is these consumers who are buying things from anywhere from cars to medicine to just the basics. Hopefully that answers your question.
Oh, that was good. Folks, we're getting towards the end of our call here. Is there anybody else that has a question or a comment or anything while we've still got our Capital Group friends on the phone? Well, if not, listen, I want to thank, first of all, Capital Group. It was really nice for you guys to make yourselves available today. And all of you that are on the call, I know, I'm gonna just kind of end the presentation portion by just making one more plea to please, as you do your reviews and as you look at your client accounts, take this opportunity to make sure that the accounts are rebalanced properly and that you've done a good job of keeping the appropriate amount of risk and allocation in those accounts. I think, it is one of the opportunities that volatility gives us, is being able to go in and have that discussion and have people listen to it perhaps a little better than when it just seems like the market can do nothing but go up. So let's be sure we're having those conversations. Year end and the beginning of the year is usually a pretty good time for that. So please, anything we can do to help in that area, let us know. And the other part is everybody stay safe. This has been a pretty tough week or two here, certainly in both Northern and Southern California for everybody. We've got a number of people that are still very kind of fluid and getting either back into their homes or kind of staying nimble when it comes to these winds and the prospect for future fires. So please, everyone, stay safe, keep your family safe, and let us know if you are disrupted, what we can do to help you on the business or personal side. We're more than happy to do everything we can. So thanks again, everybody, and we'll be following up with one more call for 2018, and we'll give you some updates on that very soon, and we'll follow up also with some info from this call. So take care, and thanks so much.
Thanks, everybody.
Thank you.
Thank you.